last 14 years of investing in real estate, I've been to a lot of different conferences and a lot of different meetups and just big events where there were often speakers who would come in and they talk about funds and syndications. Now, typically the audience, and this was myself included when I first started out, is a lot of this was just way over your head and it was really hard to understand. So my goal today is when I kind of go through these slides, I want this to become relatable and digestible to you and kind of meet you where you're at and kind of help you along the journey so you guys can ultimately understand this. And then by the end, I'm going to kind of go through like, hey, what does our company specifically do in our strategy? And then as we kind of wrap everything up, my hope is that you can actually take some actionable steps so you can go get your start in real estate, whatever that might look like. So I got a couple legal disclaimers here. You guys can, I'm not going to go through and read all this, but this is definitely important stuff that everybody should understand when they are investing, especially in a syndicate or a fund. So talking about those 14 years of real estate investing, so I want to kind of tell you guys kind of where I've came from, and hopefully you guys, some of you guys can relate to some of these stories. But also ultimately, all this wasn't built in a day, right? This was built over 14 years, right? I have a fully integrated real estate company, but it didn't happen overnight. So it really started, my first job out of school was with Shell Oil Company. I worked as a drilling engineer. I worked on drilling sites and on frac sites. I worked for 2 weeks in the field, and that's what allowed me to build my real estate company. Is I would go to the field and I would work for 2 weeks on a drilling rig or a frac spread. But on my 2 weeks off, I wouldn't have any responsibility in terms of my W-2 job, and that allowed me to go start looking for houses, start managing my rentals, start fixing and flipping houses, and go and ultimately start to build a wholesale company. So kind of how it evolved was the first company I built out, you'll see here, is Gregersen Properties. This is today my management company in my property management side of the business. We actually use virtual assistants now to help us manage this business, which is something I did. It was actually when COVID hit in, what was that, 2020? A lot of us were laid off. I was sitting at home, and just like a lot of other people were, we couldn't go anywhere. And I read a really impactful book, which was 4-Hour Workweek, which taught me that I could use virtual assistants to help train and do a lot of the duties within my company. So we built out our property management with virtual assistants who coordinate with our guys who are boots on the ground, which kind of leads into the kind of second part of the equation, which was construction, right? We had to have good contacts to be able to manage all these rental properties and also manage our flips. And after years of using general contractors, what we found is bringing an in-house crew and having our own construction arm was a really big differentiator in our company. That today is our company Revive by Wow Houses. The third component, which might be the most influential one, was the direct to seller marketing. This is my WYO Houses company. I built this company. It's going on about 4 to 5 years ago, and we branded it WYO Houses because we wanted to be the number one buyer of real estate in Wyoming. And our ultimate goal is that if anybody is thinking about buying a property in Wyoming and actually starting to branch out in Montana, South Dakota, Nebraska, other markets, but specifically in Wyoming, if somebody's thinking about selling their house, we want them to think of WYO Houses first. And our marketing, our campaigns is really successfully allowing us to do this. What this allows, though, is now I can look at all the deals first and figure out, is this a deal for the fund? Is this a deal to go fix and flip? Is this a buy and hold? Many different exit strategies we have, but ultimately it hinges upon you got to have the deals, right? You've got to be going direct to seller. So we're going to go a lot deeper on that a little bit later in this presentation, but I want to kind of show you guys how we've built this vertically integrated company, again, with direct to seller deal flow, property management, and construction, having all that in one. So how does that all kind of tie in? Well, that all culminates in Bighorn Capital Fund. So Bighorn Capital Fund is a fund I designed so other people could get access to this vertically integrated company that I've made, right? These people could go in and find, because we're finding properties in Wyoming, Montana, Nebraska, South Dakota, as I mentioned, right? We're finding single family, multifamily properties. But basically, I wanted to create something to where accredited investors could come in and they could get all the benefits of real estate and participate in deals with us, right? So we actually have some equity opportunities and some debt opportunities, which I'm going to get into later. But before we get into all that, again, I want to, like I promised you guys at the beginning of the presentation, I want to really get you guys to understand real estate investing and funds and alternative investments. So when it comes to really designing a robust investment portfolio, you got to first off think about what are the 4 jobs of your investments, right? The first one is, can it protect you against inflation, right? If you're going to rely upon your job to protect you against inflation, to me, that's not a strategy. That's not a strategy I wanted to do. I know working in oil and gas, we did get little bumps each year, but when inflation started hitting, inflation was like double digits each year, I was definitely not getting a double digit raise every year in terms of percentages. So real estate specifically, or other alternative investments, there can be great ways that also, as inflation goes, your asset continues to grow in value, right? The other thing is long-term growth. You want to have something that you put money in now and it's going to continue to grow over time. I think real estate is one of the best ways to do that. How about protecting your purchasing power? Again, that kind of goes back to the inflation, right? Are you buying an investment that's going to protect that purchasing power? And the last thing is you just got to hedge against risk, right? Every investment option has its different levels of risk, but how can you hedge against those risks? So now let's talk about the stock market. I bet a lot of you guys, I don't know, I know myself included, the last 4 years of investing in the stock market has been a wild roller coaster ride, right? It's up and down. And not everybody, well, I'm just telling you, this is why alternative investments are so compelling, right? You can go, you don't have the volatility. You're actually not, like, for example, in real estate, you are not necessarily tied to the volatility of the stock market. Just look at the last 4 years. Real estate, it probably had a little small dip, but in some markets, this was just like a blip, and then it just kept going up, right? Versus the stock market's been all over the place, and it's really been unpredictable over the last 4 years. Versus real estate during this period of a high inflation has just continued to go up. And the other piece of real estate is you get the enhanced returns, right? You're getting better returns, and I'm going to show you guys a couple graphs in a second to really show you the returns you can get in real estate and how it compares to a typical stock portfolio. But the other piece I wanted to mention is you want to pick an investment vehicle that allows and gives you the flexibility and the freedom that you want, right? This is, like, personally, big reason why I kind of went all in on real estate is I want to have a flexible job that would allow me to be there for my kids. One of the things I love doing most is coaching my kids' sports. And ultimately, that's why I left my W-2 job and came into real estate, so I could have that flexibility and I could start to create passive income that would allow me to give me the lifestyle I wanted. I think that's why a ton of people get into real estate is they want to have passive income so they can do what they want, so they can get their time back and ultimately use their money to buy back their time, right? Real estate is one of the most powerful ways to do that. Real estate investing, or just investing in general, is a journey. A lot of people, when they first start out investing, the kind of basic way to do it is a 60-40 split, right? We're talking about stocks and bonds, and your split might be different depending on your risk and age, right? But the ultra wealthy, they're not just investing in stocks and bonds. They're investing in all sorts of different assets, right? This pie chart shows you what the ultra wealthy, how they invest on average, right? You could see from private equity to real estate, all these to cash, all these different ways they invest, but they diversify and they do multiple options, guys. And now I want to show you guys how that can impact you over time, right? So this is based on a $3 million portfolio. And you could see the lower line is if just a traditional 60-40 split between stocks and bonds, right? But the second line is somebody who is actually getting into alternative investments. They're investing in real estate equity, real estate debt, right? They're still doing stocks and bonds, but they're doing it all together. You guys can see this is over 20 years. You can see the big difference between that portfolio of just doing the stock market and bonds versus doing alternative investments. So guys, if this to me is the proof in the pudding that if you start now, the returns and the growth, it's right there. It's a huge gap, right? But if you wait 10 years to start it, you're not going to see the same growth. That's right. It's the same concept investing now versus later, but getting into alternative investments, investing like the wealthy, like the true ultra wealthy invest, you got to start today. So why invest in real estate? I have 3 main reasons why. You just had one of these reasons to invest in real estate. I think it's enough. And a lot of people purely just invest in one of these reasons, right? The first one is cash flow. There's a lot of investors that pick real estate because they like the cash flow. They like the fact that whether it's monthly, quarterly, or yearly, they're getting paid monthly based on their asset. The second piece is appreciation. There's a lot of investors that purely invest for appreciation. They don't care about cash flow or the tax deductions. They just love appreciation. If you look over time and see how much real estate has gone up, like, everyone's seen it, right? And that's why a lot of people choose to invest in real estate, but it keeps going up with time. When you combine leverage with this and you can actually use the bank's money and get appreciation on the total asset value, guys, this creates long-term wealth, I'm telling you. The third thing is tax deductions. Again, I'm going to say that I know a lot of people, a lot of investors that purely invest in real estate. They don't care about cash flow or appreciation. They just want the tax deductions. This might be people that are making a bunch of money in their W-2 job, or maybe they have a business that's throwing off a lot of money. Well, they need some sort of tax deduction, and real estate can be a great avenue for having tax write-offs. And it's just the way that the IRS in our country wrote the laws. We can actually do this the right way and get these tax deductions and take advantage of what ultimately, at the end of the day, our country doesn't want to invest in the private. The government does not want to own all the property. The government wants the private sector to own properties, and that's why they created all these tax incentives. I'm curious out there, how many of you ever heard this reason why not to get into real estate? People say, I don't want to be a landlord. I don't want to manage tenants, trash, and toilets. Like, that's not for me. That sounds like a headache. A lot of people will not even get into real estate for that exact reason, but they don't realize that you could actually invest passively in real estate and not have to worry about all that. I can tell you from my experience, this is something I managed for years. I was having to take all the calls on the weekends and deal with tenants and do all this, and it was a headache. Right. But eventually I kind of broke through that threshold to where I had enough units to where I could go hire people to do this. And I just had enough volume to where it justified paying somebody to do this. So now I don't have to deal with all these headaches. I have a company that I can control and that I have management over, that we can actually manage our own properties and not have to deal with this, which ultimately what we can pass on to our limited partners is make this passive to them so they don't have to deal with it. Again, we have a company dedicated to do it. So I share this with you guys because there is a way to do this, and it's investing passively. Now I want to get into our specific investment strategy, right? What are you getting with Bighorn Capital Fund? What are you getting with my 14 years of building these vertically integrated companies? The biggest thing is, what do we focus on, right? So we're focusing on single and multifamily assets, right? And where is this at? This is in Wyoming. This is in Montana, also looking in South Dakota and Nebraska. But the really core areas is we're going to be talking about Sheridan, Wyoming, Casper, Wyoming, Cheyenne and Laramie, a couple other markets. And another big emerging one we have is Billings, Montana. We're really bullish on Billings and doing a lot more volume there. I think Billings is poised for a lot of growth. And then the last one that we just started in the last couple months is Southwest Wyoming. If you guys have been following some of my videos and YouTube channel, you're seeing that there's a ton of jobs coming to Southwest Wyoming, and this market is still very affordable. So that's another one I'm very bullish on. But the other part of our strategy is we're always looking for value add. And when you have in-house construction, this is the way to go, guys. You can create so much value and we call this forced appreciation when we buy a property that needs work, and we can go in and add value to the property through our construction, or maybe it's just through going in and doing better property management. But this can create a ton of value both for our company, but now through Bighorn Capital Fund, it can create a ton of value for our limited partners. The last thing is, what properties do we look for, right? We're not going out there and finding the A-class properties, because to me, there's not a whole lot of value added in an A-class property because it's already A-class, right? And you're going to pay a premium for those properties. Also, what I don't love about A-class is if there's a recession, what happens to all the A-class people? All those people fall down to B and C-class, right? If you can't go afford that beautiful condo, now you got to drop down and you got to live somewhere, right? So that's why we love kind of being in that B to D range, right? We'll sometimes buy a C or a D and upgrade it to a B or a C. But I love that because we've always got that kind of insulation where if we go into a big recession and rents, all of a sudden people can't afford rents, they're going to drop down, but we're still going to be sort of insulated, right? You never want to be in the top, and I also don't want to be at the very bottom. I like being right there in the middle. I want to take a minute and dive deep into our value add strategy and each component of it and how it all works together. So it fundamentally all starts with going direct to seller. We are negotiating with sellers every day. I have 15 to 30 calls a week with these sellers, and we are talking and negotiating directly with them. Often they have some point of distress or some sort of need to sell, or maybe they just have a property that they don't have the money to fix up, which kind of leads into our second step, which is the value add. Very often when we buy these properties, they need some work, or there's something that needs to be done to them. But the fact that we have in-house construction and we can go in and fix them, that significantly improves the value. The third thing is, now that we've got this property purchased, fixed up, what are we going to do with it? Well, we got two different routes, right? We could just go and sell it on the open market and flip it, right? Or we could decide to hold it and keep it as a rental. And that's kind of one of our big strategies. And it's really what I feel the most comfortable doing, because we've got a property management team that can go manage these properties, and they can go get them up to market rents or potentially push the market to make them cash flow even more and increase the value of that asset, right? And then because we have a great network of lenders and banks, we can go and take that asset now that we found at a discount, we fixed it up, and we created all this equity. Now we can go to the bank and refinance and often go get all of our money back and hold that asset long term. A question I get all the time is, why do you invest in Wyoming? I live in Houston, Texas, all right? They're like, why Wyoming? Well, first off, I say I grew up there. Second thing is, it's such a great market with low competition. I want to explain to you guys like several reasons why we love Wyoming, why we love Montana, and now again, branching into South Dakota and Nebraska, right? So the biggest thing is these are stable markets, stable economies. Like they've they've done really well over the years. Even with oil and gas being up and down and very volatile, these markets have continued to stay strong. So there's a ton of jobs, right? The other big piece, and this might be the biggest one, is it's all supply and demand. There is a limited and a fixed supply of properties in these areas, right? There's not enough contractors up there, which has been another differentiator, is our company actually having contractors that can go do the work. But at the end of the day, there's not enough supply, which is really pushing up demand and pushing up prices. The other thing is the competition level. I'm in Houston, one of the most competitive markets in the country. I'm able to actually surround myself with some of the best investors across the world, really. But I'm able to take those strategies and implement it in Wyoming, where there isn't a bunch of cash buyers. There isn't a bunch of competition, but the retail market is very strong. So to me, that has always given us really my niche and really my unfair advantage, is being able to apply these strategies and apply a vertically integrated company in a market that doesn't have a whole lot of competition. The other thing is, as I mentioned, having our in-house construction companies, being able to have those relationships and being able to, that we've been in this market for years, it really differentiates ourselves. The last two components are creative finance and appreciation in rents, right? For whatever reason, I'm still trying to figure this out, and maybe it's just the fact that I present this to so many different sellers every week, is in Wyoming, we're finding a lot of people with equity. And when they have a lot of equity, or they have a loan that has a low interest rate, that creates the perfect sort of breeding ground for a creative finance deal. And I'm telling you guys, I've built my portfolio over the last 3 or 4 years. I've really blown up my portfolio using creative finance. And we're now using creative finance to continue to go take down deals in the fund. For example, I'm going to show you guys one at the very end, which is basically taking over a property where the seller had it free and clear, and we're getting unbelievable terms to take this deal down. The last thing, as I mentioned, is appreciation in both property values and in rents. Again, this is driven by a lot of the factors I mentioned earlier, as far as there's not enough supply, but there's a ton of people moving to these areas because they want to be outdoors, right? Everybody saw it during COVID. Everybody moved out of California and New York. They out from the coast, they started coming in, right? They went to places like the Sun Belt, but they also went to places like the mountains. They went to Wyoming. They went to Montana. They went to South Dakota, right? They wanted to get into some space. People just, after being pent out during COVID-19, people wanted to go and get to these big open places by national parks. And these just areas are continuing to grow, but there's not enough inventory. There hasn't been enough builders to keep up with this growth, which has really driven a lot of the appreciation and rent growth. Now that we've talked about our specific investment strategy, and I've also shown you guys like the power of investing in real estate and alternative investments, I want to talk about like, how do you understand if it's a good deal or not a good deal, and exactly how do we do it? So one really easy rule of thumb for you guys that I think everyone can remember, and I've been using this rule for years because it's so simple. It's called the 1% rule. If you take the monthly rent of a rental property divided by the purchase price, if that's over 1%, in general, that is going to be a good deal. At least in our markets in Wyoming and Montana, that property is going to have good cash flow and it's going to be a solid investment. The second strategy is, if you're going to fix and flip or trying to create some equity on a property, we want to get at least a 30% equity, or basically a 30% discount. So if you're running your numbers, you need to know what we call the after repair value, the ARV you will see. So if the ARV on the house, for example, is $100,000, but it takes $20,000 to fix it up, what we do is we take the $100,000, multiply it by 70%, so we're down to $70,000. And then we subtract off that $20,000 rehab cost, getting us at $50,000. That means for that property, I can pay $50,000. That's a really easy way for you guys to go and calculate. And that 70% can flux. Maybe it's 80, maybe it's 60, but our kind of general rule of thumb is 70%. A couple other factors we look at when we're buying properties is we love investing, like the demographics of the town, right? We love college towns. I've invested in Laramie, Wyoming for 14 years now, and it's been a really strong market for me. It's a big reason is we rent to college students, and all the parents guarantee the leases. To tell you guys a little quick story, during COVID-19, I had a portfolio in Fort Worth, and I had one in Wyoming. The Fort Worth stuff I was fighting to get, like during COVID-19 and all the moratoriums and all that, I was having to fight to get my rent, right? In Wyoming, I didn't miss a single rent. And the University of Wyoming, it was shut down for 18 months, yet I didn't miss a single rent. And the reason is the parents were guaranteeing the leases. Right. So we love college towns. There's a ton of demand in there. The other thing we look for is properties that have either a ton of equity or a good interest rate, right? And because we do so much creative finance, and you guys are going to see an example deal here in a little bit, but if I can find a deal where the seller has it free and clear, I can negotiate really good terms. Or if the seller has a really low mortgage interest rate, we do subject to, and we can actually take over their loan and take over that great 2 or 3% loan, which is ultimately going to help our cash flow that much more. The last thing we look at is, what is the current situation of the house as far as the tenant. Is it vacant? I mean, if it's vacant, that's the best, right? We can get in there, fix it up, and then put our own tenant in there and market rent. But if it does have a tenant, we look and say, hey, is that tenant on a month-to-month lease? And if they are, we could get in there. And if it's not working out, we can serve a 30-day notice and we can get the tenant out, fix up the property, stabilize it, and get it up to market rents, right? But if we're taking over property where it's a 12-month lease and it's way under market rents, those are typically properties we're going to stay away from. At some point, you might be asking yourself, well, why would somebody sell their house at such a big discount to you? Like, obviously, you're probably a sophisticated person, or at least an intelligent person that's like, hey, I can just go list my house for way more money. Why would I ever sell it at a discount? And why would anybody ever do that? Well, first off, you probably haven't sat in these people's shoes and been in their situation where whatever it might be, maybe they need cash quick. Maybe they're moving. Maybe they're upside down because they bought at the top of the market. Now the market has shifted. There's a ton of different reasons, but probably the most common one, I think undoubtedly, one of the deals we found over the years, and this is especially in multifamily, is we find what we call tired landlords. These people have owned the house for many years. A lot of times they bought this property for way, way less. They might have bought it 20 years ago for pennies on the dollar right now, right? And they can now go sell this thing, and they don't even have to sell it for full market value. They're happy to sell it at a discount because we can make the transaction easy for them. But the other piece is a lot of times these properties have been mismanaged or the rents are way below market rent. Because if you're a landlord, I can tell you this from experience, the easy way to do it is you don't raise rents and you find a good tenant, you just leave them in there, and then you could pretty much set it and forget it, right? And that's what a lot of landlords do. They don't push rents, so markets are way under. And when we come in and buy an asset like that, we can come in and get market rents up to market value. And then that has a huge impact on, I'm going to show you guys a chart in a second of what impact that makes. But ultimately, if we can bring in some professional management, we can create a ton of value in multifamily. And this seller, who again is a tired landlord, tired of dealing with it, they're happy because we make the transaction easy. We give them the price they want to do, and it's a true win-win for everybody. I wanted to talk just a little bit about our investment process and kind of how we find the property and what we do along the way, right? It's all about going direct to seller, right? We locate the property, find it, right? The next step is we go into our due diligence phase, right? That triggers when we get the property under contract. Then we can start to go in. We can bring out inspectors. We'll bring in our construction crews we call it our SOBUD TIM, right? We want to go get the scope of work and we want to go start to build out the materials list and then figure out like our timelines. So we do all those three things during the due diligence. The next step is we're ready to close on the property. So we go through the title company, buy the property, right? So now that we're on title, now the real work begins. Now we get in there, we're doing the renovations, we're placing tenants, right? But we're stabilizing that property. And then to go full cycle at the very end, we can go and sell this property. Or in some cases, maybe we'll go refinance this property and keep it. Another question you might be asking yourself is, where do you guys find all these deals? How do you source them? Well, we do a ton of different marketing channels, and I've got a couple examples here. There are a lot of people who just get them from brokers or buy from wholesalers, but the big difference with us is we go direct to seller. We do texting, we do cold calling, we do Facebook ads, we do direct mail. One of our best ones over the past 5 years has been direct mail. It continues to pay off for us. We've done radio ads, and also we've built up our website, right? And we've built up referrals to where now we do have agents or other people who will just bring us deal. But ultimately, we're always getting in front of sellers a lot of times before they even thought about selling. They're thinking, they get a postcard from us and like, well, you know what? Maybe I would consider selling. So combining all these marketing channels is what really allows us to get in front of these sellers first so we can go take down these properties. One of my favorite things about investing in multifamily properties is you aren't at the mercy of your neighbor's house, right? If you're in a neighborhood, if you're selling your house, the value of that house is based on what everyone else is selling, right? And when it comes to multifamily, while the neighborhood and the area and location does have an impact, what has a bigger impact is the expenses and the rents, right? This is a good illustration of if you literally just dropped your expenses 8%, how much value that drives. Because the way a multifamily property is evaluated is based on the income divided by what's called a cap rate. The cap rate is set by the specific market. That's more dictated based on the area and location, right? But the income is something that you can fix, right? Or you can have an impact on. And that's why when we go into these properties, if we can go in and get more efficient on the expenses and cut them down, it increases the value of the property. So this kind of shows you that. The second slide shows you this in terms of income. So if we can come in and raise the rents, like in this scenario, we're actually just talking about the vacancy. If we can just go in and fill more units and fill 20%, we can go from 70% to 90% occupancy. It makes a significant difference in the numbers, right? And then if you can go in and increase the rents by $100 across 70 units, that can make a big difference when you go to sell this property. Regardless of what investment strategy you're going to go with, it's very important that you understand the risks. Each investment strategy has its own set of risks. Real estate specifically, one of the bigger ones is the market volatility, right? If the market corrects on you, whether that's because of interest rates or whether that's because of a 2008 housing crisis, you got to be aware of that, and you got to be able to figure out how you can mitigate against that. Another big one is the construction piece. This is just an ongoing risk that I think is always going to be there. And if you don't have control over the contractors, you can't stay on budget, you can't stay on timeline, or you can't find contractors. Like, these are all risks to your project that you need to be aware of. The next thing is interest rates. I talked about that a second ago. Interest rates can majorly impact the affordability of real estate, as everyone knows. The other thing is government regulations, or inspections, or different municipalities. They can come in and they can impact. We saw this with some Airbnb restrictions. We're starting to see this even with wholesaling. They're starting to outlaw wholesaling in different states. So understanding the kind of government regulations is also very important. The last and final risk is liquidity. This is the thing that's burned so many people over the years. And when I talk to my higher level mentors, it's all about liquidity, right? In 2008, if you had cash and you were able to ride out the storm because you had enough liquidity, those people made out, they kept their assets, and they actually started buying more assets when the bottom fell out. But if you don't have liquidity, that could be a recipe for losing it all. Now let's talk about mitigating all those different risks. So first off, when it comes to like market volatility and the ups and downs, my biggest mitigation against that is having multiple exit strategies. We try to underwrite all of our deals to where if we're going to flip it, we want to make sure if something happens and the market drops, well, instead of flipping it, can we hold this thing as a rental property? Will it still cash flow? Can we still make money on this and hold it over the long run? The second thing is contractors. This is one we've been fighting for many years, guys, and I could tell you many headaches, many deals where all the profit was pretty much wiped out because of not having the right contractor in place. So what we've shifted to doing is we now have all of our contractors in-house. A lot of people use GCs and a lot of people have a lot of success with it, but when you use a GC, you're at the mercy of their schedule, right? They've got other customers and other people, and they've got other things that are paying their bills, not just you. But when we've brought our foremen, our contractors in-house, now they just work for us. So now we can control the timelines, the budgets, and everything else. Another risk, which we haven't talked about a ton, is not properly underwriting the deal and maybe overestimating the ARV, the after repair value. Maybe you pulled the wrong comps, or maybe you buy in an area where you're just like one street off from the wrong neighborhood. A lot of people can probably share examples where literally you cross one street and the values significantly change. So the way we mitigate this risk is we work with an agent, a dedicated agent in every single market that knows the ins and outs of the market, right? There's no way for me to know every single market that I invest in, but if I've got a partner that I trust, that I know knows the market, they can really help you stay out of trouble. And the other thing is just doing a ton of deals. I talk to 15 to 30 sellers per week, and I'm constantly underwriting deals. I'm constantly seeing deals, and 14 years of experience makes a big difference, guys. There are a lot of deals when I first started that I thought were deals, but you just learn over the years. I mean, if you've ever lost money on a real estate flip or buy and hold, it teaches you a hard lesson, right? And you learn to be more conservative on your numbers. So that's probably one of the biggest mitigators is we underwrite conservatively, and we work with local agents who know the market better than anyone else. The other way we mitigate risk, and this is mainly having to do with like the contractors and the volatility, is just the sheer volume we do. We're doing so many flips per year that I'm able to keep multiple crews busy, and we're constantly like in the market. We can keep guys. I've just found with contractors over the years, if you can't keep them busy, as soon as the market heats up, they're going to go take the job with the most money, right? But if we keep our guys busy year round to where they keep working for us. And now we can keep that. That just allows us to, when the busy season comes up and everybody wants to leave and go find another job, they stay on our jobs stay on timeline, so we can continue to stay on timeline, on scope, and on budget. The other risk I talked about was interest rates. Like, what happens if interest rates go up? Well, that's where creative finance has completely changed the game for us. Over the last 18 to 24 months, when they started raising rates, we quickly pivoted and started going with creative finance to where now we were buying properties where we were able to take over the existing loan. Or maybe we were buying from somebody who had the property free and clear to where we could set up a favorable interest rate and still make the deal work. The interest rates has knocked a ton of wholesalers and a ton of flippers out of the game in the last 24 months, but it's allowed us, we've actually grown even more during this period because, again, they're out of the game. We're still in it, and we're finding even better deals because there's ultimately, when interest rates rise, there's less buyers in the market, which has really been favorable for us. The last risk I mentioned is liquidity, right? If you have a lack of liquidity or you have a property that can't be sold, you can get into buying, right? Where we've mitigated this risk is we have a great network of investors, not only from people that are cash buyers that we could go and unload some of our properties if we needed, but also investors who could come in and potentially partner on deals to where we could have, if we needed an influx of cash, we could bring it in. We also like to use lines of credit, right? Lines of credits give you a ton of flexibility because you only pay interest based on what you're using. and it allows you some flexibility if there is a liquidity crisis, because everybody in real estate, you're always looking at your return on investment, right? If you got a bunch of cash just sitting, you're not getting a return on that, but you also need cash and liquidity to stabilize your business in hard times. So we try to use lines of credit and also relationships with other investors. Another key risk when you're fixing and flipping or buying a rental property is not conducting your due diligence on the front end, right? If you miss a foundation issue, I'll just tell you one story, guys. We bought a property. This has been like 6 years ago. I bought it. I thought I was going to gut it and do everything anyway. So I'm like, I don't need to worry. I don't need to get all these inspections. Well, lo and behold, as soon as we gutted that house, we found out the framing was so shot that we had to tear down the house. And that was a great learning lesson. It's actually one of my better assets today, but I had to put way more money into that property than I wanted to. And it taught me an invaluable lesson that, you know what, no matter what, you got to go get inspections. You got to know what you're walking into. So we take the time on all the deals that we purchase to go through that inspection process, whether it's a third-party inspector or it's one of our in-house guys that goes through a thorough inspection to make sure before we buy that asset, we know what we're getting into. A second way that we mitigate risk when it comes to the volatility of the market is we create these, we call it our revive method, but essentially it's like a partnership with a seller where this works really good when we're taking on a property that needs a ton of work and there's not a whole lot of people that can buy this house because it's such a big job and they don't have the contractors. Well, what we'll do is we'll tell the seller, hey, we'll take over your loan. I'm going to go pay for all the construction to flip this house. But when we sell it, obviously the loan's got to get paid back. And then I get paid after that. We get to pay back our construction costs and then we profit share after that. So that's been a huge risk mitigator because I know that if I had to sell this house at a big discount because the market shifted down, I'll still be okay, right? Because there's enough margin between the purchase price plus my rehab that I'm still going to get paid back. If we get to have profit share on the back end, that's great, right? Really, I'm mitigating all my front end risk by structuring it that way. A third way to mitigate risk when it comes to market volatility is buying at a discount. They always say you make your money when you buy. And because we direct to seller and we buy at such a discount, we can mitigate a lot of that risk. I told you guys about that 70% of the value. That's where we're building in literally 30% cushion on the deal. And if you're going direct to seller and negotiating that, you can do it. If you're buying your deals from someone else and they're taking 20 or 30% out of it, or maybe even 10, you're just lessening your cushion. But again, because we go direct to seller, we build in our cushion on the front end. One very important lesson I've learned over the years is to always have multiple exit strategies. And I want to kind of go through with you guys our 3 different exit strategies. And if you guys hear anything, if you're looking at any type of investment, if there's only one exit strategy, that's never a good place to be. You always need to have multiple, right? So if we're doing a fix and flip, our first primary exit strategy is going to be, again, fix it up or find the deal, fix it up, and then go sell it on the open market, right? But what if their market changes? What if we see shifts? We talked about all those risks. Well, one risk mitigator and one second exit strategy is, could we keep that property? Could we actually go put a tenant in there and make enough money from the rents to pay off if we used a mortgage or use some sort of debt? Can we still pay the debt with the rent, right? That's a great second exit strategy and one we use very common. The other thing is and this is kind of more of a long-term play, is as we build up more assets and more properties and continue to cash flow them, ultimately there's all these hedge funds out there. I mean, if you guys aren't watching the headlines and seeing all these BlackRock, you're seeing Chase, JP Morgan getting into it, all these big companies are wanting to buy up big rental portfolios and cash flow them. They're seeing the power of what we've been talking about for this entire presentation, all the value in real estate, they're seeing it, right? So if you can bundle up all these deals and sell it to a big syndication or a big buyer like that, that could be another great exit strategy. What makes us different? What makes Bighorn Capital Fund unique? The first place I always go there is our vertical integration, from going direct to seller and sourcing our own deals to finding or having our own in-house contractors to having property management in-house. Having all 3 of these businesses allows us, each one of these businesses could be profitable in itself, but when we work them and they have synergy all between them, it just makes us more competitive than anyone else. The other piece is I talked a lot about the different risks. Let's say you hit one of those hurdles or one of those risks, the fact is, because we have all 3 of those components, maybe one doesn't go as well. Maybe the construction doesn't go as well. Well, you know what? We found the deal at a discount and we could manage it. That's one way to mitigate it. Or maybe we bought the deal wrong, right? Well, maybe we can go save some money on the construction, on the property management to mitigate all that risk. To me, that's one of the biggest risk mitigators we have is being vertically integrated. The second thing is underwriting and transparency. The feedback I've gotten from our investors is they just really appreciate how much detail we show them. I've been underwriting deals for 14 years. I know how to do it. It makes sense to me, right? And I'm going to go through the process on every deal and underwrite it myself. So what I do is with our investors is I share that underwriting so they can understand how to do it. I allow them opportunities to ask questions. A lot of our investors have purely invested because they just wanted to learn how to do the deal. They wanted to learn how the deal works. And we're very transparent and we love helping and showing our investors to where if they learn how to do it and eventually they want to go off and buy their own deal next time, I think that's awesome. I just want to be able to help them. But ultimately, people don't invest in things they don't understand. So we try to go the extra mile and really explain and are very transparent on how we underwrite our deals. The third and final thing is our market share we have in Wyoming and Montana and the fact that we are so insulated in those markets. Because we are the biggest player in these markets, we have access to the best contractors, we have the best agent connections, and again, we have a huge property management team that can go manage all our different properties. This allows us, when it comes to deal flow, like we're constantly getting deals thrown our way because people know we're the biggest operator in the market. And again, if we get in a bind where we need to do some crazy foundation repair, I've seen that before, or run into something where we can't get permits with the city, again, because we have such a vast network and we're the biggest player in the market, we get a ton of just, again, we talked about risk, right? I keep hitting back to this. You've got to be able to mitigate risk. And one of the big ways we can mitigate risk is because of our market share and the fact and the breadth and of everything we're doing across Wyoming, Montana, and now South Dakota, Nebraska. I think it's important you guys understand how our company is set up. So starting from the top down, my role is the CEO and the visionary. The next big role is Clint Warren. He is our COO, our Chief Operations Officer. He spends a lot of time in our projects and doing project management. The next role is Dallin Cottle. Dallin Cottle is our Chief Marketing Officer. He's been really helping us really standardize and make our entire marketing system more efficient and robust. As we move on, I want to talk about our needle movers. First one is Judith Allen. Judith Allen is our lead manager and focused on acquisitions. She is my right-hand gal when it comes to finding the deals off market. The next one is Alyssa Stutzman. So Alyssa is our head of dispositions, and she also is our head of investor relations. If you're probably going to be meeting Alyssa along the way. She also helps me as my executive assistant. And then the other couple guys we have is Joe Kettner and Edward Timmons. Joe is one of our focal points up in northern Wyoming, and he helps us with construction. Edward is our team lead in terms of maintenance. He's actually been doing maintenance for many years and helps us down in the south part of the state of Wyoming, and he does a phenomenal job for us. It's also important you understand where we come from as a company. We kind of set these core values. It's been about 4 years ago we set these because these were the core things, and it took a lot of time to think through these and really build them out, but it's based on humility, ownership, and perseverance. We will literally hire and fire based on these three different things. When we're doing a job interview, we ask people to illustrate, hey, how do you show humility? How have you taken ownership? How have you persevered over the years? And as these people get into their roles and get into our company, we continue to instill this. And there are times where we've had people that didn't have humility. They didn't show ownership, and those people ultimately didn't last in our company. So these are kind of three key core values. And I'm hoping these are important core values to you because they're super important to me and my company. I wanted to share with you guys more on our track record. I talked earlier about transparency and showing people the numbers so they understand, how to underwrite deals, and then where it kind of comes into play here is I want you guys to see like deals we've done over time so you can see, hey, what did we buy the house for? What did we pay for on the rehab? What did we sell it for? That ultimately, if you're kind of new to underwriting and new to trying to figure out if it's a good deal, if you can kind of go see like case studies and track record, I think that really helps people become more comfortable. So what we do is we just have what we call like our vault of deals. It's like a spreadsheet, and you can see all the deals we've done over time to really get more comfortable, right? And you can dive deeper. We have photos. A lot of times we'll have like a video showcasing the deal, but we try to be, again, very transparent so you guys can go see multiple deals. And I just would advise anybody who's thinking about making a significant investment is go look at a track record, go see deals they've done. And not everybody's done the amount of volume of deals that we've done, but you definitely want to at least go see some sort of case history. The other thing I wanted to share is our pipeline, right? We've constantly have deals coming in, and we keep like an inventory sheet of all of our deals. Some of these deals we might be just selling to other investors, but you can also kind of see the other deals that are coming down the pipeline. But we always try to keep this up to date in a Google sheet. Now I want to get into some case studies and kind of dive into the numbers. This first one is One of my favorites, and it's one of the most recent ones. And as I once heard from another, really, he was a great capital raiser. He's like, you're only as good as your last deal. This deal we did in Casper. I want to show you. So the purchase price was 3.2 million. We've been rehabbing. We bought this at the end of June 30th of last year, 2023. And we've been rehabbing this we're almost done. We're actually going to be finishing at the end of this month, maybe early June. So we're going to finish in less than 12 months. At the end of the day, we rehabbed like 55 units. So the average cost was around $15,000 that we put in each unit. But here's the best part is the after repair value of this, we've already basically confirmed this at $5.6 million. The way we calculated that is we actually had one of our units appraised because there's actually a couple privately owned units and one of them sold and it appraised for just a couple months ago. It appraised for $90,000. So if you multiply that 90,000 times all the units in there, that's where we came up with that value. So that is created, guys, this will blow your mind. We created $1.64 million of equity, or basically we forced the value. We talked about forced appreciation by buying a deal, fixing it up, and raising rents. Well, we forced and created $1.6 million of value by renovating it and getting the rents up to market value. Here's a couple more case studies of flips we've done. And there's plenty of these, but I just wanted to kind of show you some breakdowns of the numbers. This one was in Sheridan, Wyoming. We did this one about a year ago, kind of shows you the purchase price. This one took a little bit longer. This was a 6-month one. This was actually the first time we used this crew. They were an in-house crew that we brought in and one of their first jobs. And the fact that they were still profitable on their first job, I think was phenomenal. I'll show you their second one. This is the second or third one they did later in the year last year. It was also in Sheridan, and you can kind of see the profitability. This one made $41,000. Took about 3 months. The last one is same crew actually, these guys hopped over to Cody and did another one. This one had a similar profit margin, took a little bit longer, but it was just another kind of cool case study. If you guys want to dive into more case studies though, again, I encourage you to go to our we call it our track record or our case studies spreadsheet. And you can kind of go look at all these different deals and see the pictures. And if you guys have questions on a specific deal, I'd love to dive into it. One of my favorite parts about Bighorn Capital Fund is that we've designed different strategies for each type of investor. We really break this up into 2 different groups. We have our debt fund and our equity fund. So on our debt side, this is great for people who want a fixed return. At the end of the day, it's basically an interest rate that you're going to get locked into to where you kind of cap your upside, but also you've capped your downside. It's a fixed interest rate. The other great part about this one is it's flexible. You don't have to plan to tie up your money for 5 years in this one. It can be much shorter term. The third thing is the minimum investment is lower on this one. Our minimum is $50,000 for the debt fund. Now let's talk about the equity fund. One of the things I love the most about the equity fund is you get all the tax benefits. Because you're a limited partner and have equity, you get all the same tax benefits that I do as a real estate investor. The other piece is you have much more upside. Because you're an equity partner, you do have risk to the downside, but you also have risk all the benefits of the upside. The last thing is you need to be prepared to deploy your money for up to 5 years if you're going to do the equity fund. Because again, it's a long-term play and you're getting all these other residual benefits. I wanted to share with you guys a deal that we're actually bringing in limited partners on this week. Guys, this is a really cool deal in Evanston, Wyoming. I've been talking quite a bit about it. I'm very, very excited about this one. We bought this one at a great price and we bought it with great terms. So here's how this works is the seller is actually going to carry over $2 million of the purchase price of this in second position. So what this allows us to do is bring in our investors in first position. So we're going to raise around $1.6 million for this. But again, the investor will be protected by a first position lien. And the cool way we structured this is we're going to pay a fixed interest or call it a preferred return on the front end of this investment. But there's going to be a triggering event on this property. And that's going to be when we refinance. Because this property needs a ton of work, it's very similar to the case study I just showed you in Casper, where we went in, we fixed it, we created a lot of value, right? This one is very similar. It's got a lot of units that need to be renovated. Once we renovate these units and we stabilize it, this asset on paper and based on cap rates should be worth $4 to $5, maybe $6 million. So once we get it to that value, what we're going to do is refinance. When we refinance, we're going to return all of our investors' capital. And when we do that, we're going to flip the equity split. So let me back up a little bit here. So going in the investment, the split will be 80-20, 80% to the limited partners, 20% to me as a general partner. But when we refinance and pay back all the investors' capital, it will flip and it will go to 20. It'll just be inverse of that to where me as a GP will get 80% and the limited partners will get 20%. But at that point, the limited partner has no money into the deal. So they're just going to be able to continue to cash flow this. And when eventually we sell this, they're going to get another little big payday at the very end of it. A really cool deal we're putting together this week. I could go on and on about the value of this asset and the drivers in this market. Guys, this Evanston is growing rapidly because of all these jobs that are coming in, and it's already a tight market. If you guys want to dive deeper, I can share a specific link that shows you the underwriting this deal, shows you why Evanston is growing, and exactly how we're structuring it all together. Something else I want to share with you guys is our organization chart. I've talked to you about our vertically integrated company, and you can kind of see it here in the 3 columns, right? You could see from myself at the top to my COO down to our project manager, and that's where you can kind of see the construction part of our company and then kind of how they go down. The other big component is our marketing team. You guys see that we're always putting out a ton of stuff on social media. Well, we do that with a phenomenal marketing team. The other big pillars, as we've talked about, is our property management system, which is led by Monica Lopez. She helps oversee both the short-term rentals, medium-term, and long-term. And then the last piece is our sales team. I still have a big role in that company as far as helping negotiate these deals, but I have a great team working underneath me, from Judith Allen to our virtual assistants who do a phenomenal job of setting appointments. But that should kind of give you a holistic feel of like exactly how our company is built out and what allows us to be able to constantly find deals, what allows us to fix them up and able to go manage the property on the back end. So in summary, I wanted to go over 5 reasons why investors choose us and kind of tie this all together. At the very beginning, we talked about you need to find, or just the importance of finding, an alternative investment strategy, something that's going to outpace inflation, something that's going to hopefully not be as volatile maybe as what you're currently investing in, whether that's a stock market or whatever it is. If you're tired of the roller coaster, find something that is more stable, something that isn't tied to the stock market, to elections, right? The other piece is helping you guys be financially free, right? And start to have more of your time back. I kind of shared my story about how I've been able to get my time back and be able to set my schedule through real estate. But there's so many other stories of investors who have invested in real estate. They've traded in their money for passive income that's ultimately given them time that they want so they can do what they want, when they want, with whom they want. The last piece is leaving a legacy, right? Buying real estate is a great way to create wealth and be able to hand down to whoever that might be. Everyone wants to create a legacy, right? And building it through real estate is one of the best ways I've seen people do it, myself included. For our investors who are ready to take the next steps, it's a very simple process. The first one is reviewing the materials. At that point, we're going to hop on a call with you, with myself or someone on my team, to ultimately guide you and let you ask any other questions to where you ultimately, as I've said throughout this presentation, I want you to understand the deal, the underwriting, all the risk components. Holistically, I want you to understand the deal. If you're comfortable and want to move forward, the next step is signing all the documents electronically. At that point, you're going to wire in the funds, and then at that point, you're ready to go. You were part of the fund, and now hopefully you could start to buy back your time. Hopefully you guys have enjoyed this presentation. And as I said at the very beginning, I'm hoping that I've simplified the process to where when you're looking at it, that investing in a real estate fund isn't this big confusing thing. If you have any follow-up questions, I encourage you to reach out. Hopefully you can see from today's presentation, I love talking about this stuff. I love helping with you guys. So I'd love nothing more to be able to get on a call with you guys. And whether you want to talk about a specific deal, talk about risk mitigators, whatever it is, I'm here to help, and I would love to help you guys. To conclude, I want to thank you for taking your time to watch this presentation today. We've covered a ton, and I want to encourage you guys, if you have any questions on anything we covered today, please reach out. As you can see, this is my passion. I do this day in, day out, and it's so much fun. And if I can help you or answer any questions, I really, truly encourage you to reach out. I really do look forward, though, to continue to help you buy back your time.